I started buying Alibaba stock back in 2021, and I've dollar cost averaged down over the past 3 years as it fell. Now, along the way, I also had shares taken away from me from covered calls. This year, in the last 52 weeks, Alibaba's low was $66 per share, and I continued to hold on to my shares. And there was a lot of criticism of it, and there's a lot of criticism of Alibaba. Yes, it's in China. There are a lot of fears out there, but you have to remember that Alibaba is now skyrocketing and has started to sell at a 52-week high of $116 per share, and news follows the stock price. When Alibaba was over $300 per share, nobody could ever talk about the fact that it's an ADR, you don't actually own the company, you always own a piece of the cash flow, blah, 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 blah. Taiwan then became a big issue as the stock started to fall, and the ADRs became a big issue. Now, recently, as you can tell, here's the performance of Alibaba. Up 55% in the last 6 months, up 48% in the last 3 months, up 50% in the last year, since the beginning of the year. Does that mean I'm right? Absolutely not. In fact, recently as Alibaba surged, I got a lot of messages from people. Paul, you did great. Guys, I'm not right on Alibaba yet. I even wrote this Twitter post. I received many comments about Baba asking me if I feel good that I was right. First, thanks to everybody who said it, but one, I don't know if I'm right yet, nor do I think I'm right yet. Two, I can't say I'm right if it goes up 30%, just like if the stock went down 30%, that wouldn't tell me that I'm wrong. Guys, remember, the goal here is to sit there and buy companies at great prices. In the short run, people's sentiments and feelings are going to drive up the stock or drive down the stock. What we have to look at is the fundamentals. And if you look at all of our past videos on Alibaba, I focus on the fundamentals. Did the growth story match what everybody was paying for before? Absolutely not. I want you to become an investor who looks at the fundamentals of the business in relation to the price the market is set to determine if you should make an investment. But you have to remember, in that short run, stocks can go up and down a lot. Guys, you cannot find me a stock that just stays, that as the company fundamentals go up like this, the stock price goes right in tandem. Here's what actually happens. Fundamentals go like this, stock price goes like this. The question you have to ask yourself is, when it's down here, are you willing to buy? Because remember, when it's down here, the news in the company is going to be very bad because news follows the stock price, not the other way around. And every time I kept looking at this company, don't get me wrong, did I have worries about China being a communist state? Yeah, but I thought to myself, okay, if I were to make a bet on China for the next 20 years, are they going to become more capitalistic or communist? And I thought to myself, well, the last 20 years have been more capitalist, and the world's more and more capitalist. Why would this revert back? I don't know. Population decline, is it bad? Yeah. But I also look at what's the average income in China. They still have a lot of growth there for the average income in China. That's very, very important. Another thing I looked at, after the 50% run up in the stock price, it's currently only selling for 14 times its price to free cash flow. 14 times. That's after the recent run up. You look at PE, it's 28 times. Why? Look at the free cash flow. In the last year, $20 billion. In the last 5 years, it's averaged $20 billion. Yet its net income was only averaged $14.5 billion in the last 5 years and $10 billion last year. This market cap was a lot lower. It was $150 to $180 billion, generating $20 billion in cash flow. And not only that, even all the negativity out there, let's look what analysts were saying. Yeah, it wasn't good in terms of EPS, but guess what? It wasn't declining overall. Even the analysts who are going to sit there and follow what people are doing, you sit there and look at this and saying, if I can pay single-digit price to free cash flow for a company that goes nowhere in terms of growth of its earnings, as long as they buy back shares, I'm happy. And speaking of buying back shares, what has Alibaba been doing? They've been buying back a ton of their shares. Why? Because they're smart and say, wait, we have the stock selling in the single-digit price of free cash flow. Let's buy back our shares. And don't also forget about how many major investors have started to pile into these companies. Now, keep in mind, guys, this stock right now, going back to it, is at $112 a share, down 2.8% today. Guess where it's going in the next 3 months? I have no clue. Guess where it's going in the next 6 months? I have no clue. In the short run, we have no idea where these stocks are going. But if you're going to make your determination on buying a company, whether the stock price goes up or down, you're not an investor. I want you to be an investor, and you want to be an investor. That's why I need to understand this. A lot of the stocks I buy are based on buying when the sentiment of the company has shifted. I bought Nike recently. I bought Starbucks recently. Why? Because the sentiment around these companies has absolutely changed as the stocks have fallen. Same thing with Alibaba. Now, Alibaba has a lot more fear behind it, right? Well, of course it does. And in a few minutes, I'm going to show you the stock analyzer tool and why the returns are offering that potential to match those fears. Remember, the more fear, the lower the stock price, the lower the cost of the investment, and the more potential. Doesn't mean it's going to work out all the time. But if you're able to buy 20 or 30 companies that have immense fear in them, but the fundamentals tell a different story, you're probably going to do very well. Now let's look at the 8 pillars of this company. Guys, net income, not worried about that because we looked at the free cash flow. It's down a little bit, but not nearly as much as net income. Net income's down 15 billion. Free cash flow is only down 1.8 billion. This is the metric that matters most. I love the fact that their free cash flow is higher than net income. Revenue growth, 57 billion in the last 5 years. Low debt, low price to free cash flow, still a low PE, even though the price to free cash flow is lower. This is one area I'm not a big fan of. Low return on invested capital. I'm hoping that's because they've been getting themselves back together, getting ready to keep regrowing and putting more money back into the business to grow. But even with that, you'll see shortly in our stock analyzer tool that there's still a lot of potential for this company, even if they just maintain and grow at a slow pace. Now, all of these things that I've done, this is why I created this software. I wanted to be able to look at the high level of these companies because I truly believe that a lot of people over-research their investments. That's a very common theme. My biggest fear whenever I look at anything is, am I overthinking it? But that's why I've changed my investment philosophy to buy big name brands, big companies that probably are not going away. The reason I do that is I'm okay making less return as long as that return is more stable and as long as I'm taking advantage of other people's emotions. And that's the same thing I want you to do. That's the same thing a lot of these people in our community, the thousands of people in our community are doing. Now, if you've thought about joining and you've gone to our website, you've probably seen that we have a limited number of daily spots for our community and software. And the reason for that is the software as it exists today includes everything we have to offer for retirement, for real estate, and for stock analysis. To be fully transparent, we currently have 4,000 people who have taken us up on this offer. And after we reach 5,000, we're going to update the software to make the changes. We are going to change these offers and split these off separately. So we're only 1,000 users away. The current offer of everything is going away. Now, if you remember when we first started this channel, I just got a message yesterday on Instagram from a guy who said, Paul, I've been watching you since it was an Excel sheet from YCharts. And I was like, oh my God, this person's been on for so long. Because I built the software for myself through YCharts. But as I started to use this, people would say, how do I get that software? How do I get that Excel sheet? And I said, you can't. It's a data feed from YCharts that costs $500 per month. But it got us thinking, wait a second. People want to be able to analyze. People want to be able to be part of a community talk. Let's give it to them. And as the community has grown, we've become less about me and more about how I can better serve you and the other community members. So the good news is these changes haven't been made. We're not at 5,000 users yet, but we're working on them every single day. So if you join today, you'll be grandfathered in for life with all the data, all the tools, everything. So if you're really serious about making better financial decisions, probably increasing your returns, but more importantly, sleeping better at night and making less irrational emotional decisions, click on the link in the description below to get access to our software. We have a great $7 for 7-day trial, so go take it up. Now, let's go look at the stock analyzer for Alibaba, and we're going to do 2 different analyses. We're going to do one having to do with one assumption. So I'm doing a 10-year analysis here, but I'm only putting one assumption for this first one. Stay with me for the 3 assumptions. I did 6% revenue growth. Guys, in the last 10 years, I did 33%, last 5 years, 18%, last 1 year, 6%. But as China grows, as the world grows, they will grow at a better clip. I'm still comfortable at 6%. Profit margin, I put in 15%. Remember, this profit margin is net income. It's been heavily kept down. I'm focusing on free cash flow here. Free cash flow, I'm putting in 22%. It is down over the last year, but let's then actually just be conservative, let's go 18%. PE, I put in 18 and price of free cash flow of 18 and my desired return of 9%. Now remember guys, this is my intrinsic value return. Intrinsic value, this is not the return I want. You should not be buying individual stocks to match the market. 9 or 10% is going to match the market. You need a premium, but I want to show what the market return would make the stock worth. Boom. 177 based on multiple of earnings, 212 based on a discounted cash flow model. That gives at the current price, not at the 66 or the 70 that we were adding more and more shares at, gives it an 18% return. Now, the 3 stock return, there's 3 stock assumptions. Now again, I'm going to change my assumptions on the free cash flow much, much lower. I did 3, 6, and 9% revenue growth. I did 12, 15, and 18% profit margin, 15, 18, and 21 free cash flow. PE and price of free cash flow, 16, 18, and 20, and 9% return. Hit the analyze button, boom. Low price of 130 based on free cash flow, high price of 335, middle price of 212. Guys, if you want to see the 18 stocks that I own, please watch this next video. I'll see you in the community. Thank you for your time.